My dear friends and investors, hope all of you have had a lovely Diwali and a superb festive season, and you had a great time with your family. Now that all the excitement about GST cuts and the festive season is behind us, let's get down to brass tacks. This month, we will talk about earnings and the trends that we have seen as the Q2 earnings start rolling. And what do we see here? I think we have good news. After several quarters, we are beginning to see that the Q2 numbers are better than what most market participants and analysts expected. As usual, we will start with the scorecard of the top 500 companies or the NSE 500. Of the 500 companies, roughly about 82.5% of the market cap has already declared their results, which is roughly about 363 companies. And what we see is that revenue is up roughly 9%, but the profit after tax is in double digits at 16.6%. Yes, we are back to double digit growth after several quarters. If we now break this up into various market cap ranges, we see that as far as the large caps are concerned, profits have grown at 9%, still single digits, but higher single digits. Mid caps continue to shine at 23% growth, and small caps, which until recently was struggling at single digit growth for several quarters, just like the large caps, have now swung to a 33% growth in profits. So yes, we are beginning to see a significant revival in the aggregate profitability, and this time it is being led by small caps, followed by mid caps, and then the large caps. And if you look at the chart, which is very interesting, if you look at the YOY growth, and we've plotted the YOY growth right from the quarter of September 23 up until September 25, you will see that we saw a steady deceleration in growth rate right from September 23, when the growth was at 35% for the top 500 companies, which fell to as low as 6.3% in September 24. And in the latest September 25, for which roughly more than 80% of the results are out, we are at a 5-quarter high of 16.6%. And that gives us significant confidence that the bedrock of the equity markets, which is earnings, has started to revive. And therefore, there is a very high possibility that by the time we close this earnings season, we will see the end of downgrades and the beginning of stability and upgrades and growth coming back. We now go and delve a little bit deeper into how some of the key sectors have done. And what we have done is that this time we have ranked the sectors based on their EBITDA growth. And if we look at the top 5 sectors which have really outperformed, remember, EBITDA growth for the NSE 500 has been in the range of 29%, PAT growth was 16%. But if we look at the top 5 sectors, it is led by the so-called new age or e-commerce companies. And what has happened? Well, YOY, the top line has grown at a staggering 84%, which has actually led to the swing from loss, EBITDA loss, to EBITDA profit. And this has then carried through even to the bottom line. So we've seen a significant discipline an improvement in profitability in the new age or e-commerce companies. Naturally, if you look at the price performance of many of these stocks, especially the ones that have been around for some time now, we have seen a significant re-rating in those companies. The second sector which has seen a significant swing in profitability is cement. And this has happened A, because of pricing discipline, and B, because there has also been a lot of efficiency and cost cutting that has happened. Usually Q2 is not a great quarter for cement, but despite that, the sector has done reasonably well. Third is energy, but the big swing in energy is largely because of the oil marketing companies, and that's because we saw a significant correction in crude oil prices, followed by textiles and telecom services. And when we then look at the bottom 5 sectors, there is one change. In the previous quarters, whenever we would talk about the bottom 5 sectors, typically they would actually have a negative earnings growth. However, this time it is not so much of a negative earnings growth, but it is relatively a slower growth. And the bottom 5 sectors are consumer staples, logistics. However, the number in logistics was largely driven by the loss in Indigo, and that was large part of that had to do with the currency movement. So if you strip that out, then logistics probably wouldn't have done that bad. Infrastructure, understandable, because we had extended rains in Q2 this time, and therefore also not the strongest quarter for this sector. Consumer food and chemicals. We have started to see some sporadic improvement and revival in a few chemical companies. It's not across the board, but we are starting to see some level of improvement. And finally, I think what is important from a stock price perspective is that usually what is priced into the markets, and then when the actual numbers come, are they better or worse than estimates? And here also we have a lot of good news. If we look at the large caps, the large cap profit after tax is roughly 3% higher than analyst estimates. Mid caps, though, have fared significantly better. There is a 11% outperformance versus consensus estimates, and small caps have also outperformed, albeit with a very low margin, which is 2%. But the fact remains that all three, large, mid, and small caps, have actually delivered better numbers than what the consensus estimates. And that, my dear friends, gives us the confidence that this sideways market that we've seen for almost over a year, while we may think that there are several other factors that could have been the reason, which is continuous wars, the trade and tariff problems, but the real reason why the markets were range bound for almost a year and we've had very little net positive returns is because earnings were struggling. And now that earnings have revived, we believe that amongst other things, if we see an even stronger earnings season in Q3, which I think is a great probability because the real benefit of GST will only accrue in the October to December quarter. So I think truly the second half of this year should see a significant growth in earnings revival, and therefore we believe that the probability is very high that the markets will finally get out of this very tight range that it has been for over a year and touch new highs. We will, however, come back to you next month when we have the full picture of the earnings, and hopefully we will have even better things to say. So for now, thank you and goodbye.